Institutions manage money on behalf of all of us, all of us who put our money into pension funds or into mutual funds. But their assets are quite large. So, you need different tools if you want to trade $100 million of something versus if you want to trade $1,000 worth of something, right? So, you want to trade $1,000, you can pull up a screen on a retail trading platform, hit a button, have it executed, no problem. But if you want to trade $100 million worth of a particular security, that's a problem. And what that requires are different tools than what a retail trader needs. And you need a wholesale marketplace. You can't expect that Marks and Spencer's is going to go to the corner grocery to buy everything that they have to furnish for all of their stores in the country, right? Well, that's what we created, is this wholesale marketplace. Now, what regulators have found around the world is that not all dark pools are the same. And in fact, when they started shining a light on some of the internal practices of those dark pools, what they found was in most of those dark pools, the average execution size is no larger than what's found on the exchanges. Now, an institution needs a bulk execution. They need large block executions, not things that they can go to the exchanges for. And that is uniquely what Liquidnet provides for them. The regulators all over the world have basically said, if you do not provide value above and beyond what can be found on the exchanges, if you're a dark pool, you should probably move your volume back to the exchanges. Dark pools are there to service institutional investors, not retail. It actually is a very good value, but the difference is that the exchanges provide quotes. You can go to an exchange and you can see what the bid and the offer is, and they call that a lit market. In a dark pool, can you imagine that there's not a large institution that would like the rest of the world to know that they want to buy $100 million worth of something, because supply-demand will simply move the stock price against it, and that would be bad for all of the investors that put their money with that asset manager. That's why dark pools were created, so that we know they have certain demand and certain supply. We don't publish quotes. We don't publish that demand for everyone to see, because that would move the markets. So that's the protection that we provide to all the investors who invest their money with these asset managers. So the exchanges are lit, and the pools like us are dark. We're not publishing quotes. But what we do is every execution that we do execute, we report to the exchanges. So we are part of the market structure in every country in which we participate. We are part of the market volume in every country in which we participate. And we think that that is absolutely critical, because the exchanges are complementary to us. We need the exchanges to exist because they are the price formation mechanism. They are the volume consolidation mechanism. But what the exchanges cannot do is they cannot do quantity discovery. They cannot provide the same service that we provide. They cannot handle the institutional business efficiently, which is why we were created. So we're so complementary to the exchanges. They provide price formation. We provide quantity discovery. And together, we can support both retail investing and institutional investing that much more efficiently. What we say is that, ideas are a dime a dozen, right? You can have the greatest idea, but if you can't find the liquidity, what good is it, right? So you need the liquidity, but you also need the regulations of the market as well. We can't have the Wild West here. I mean, there are reasons why the world blew itself up in the financial crisis, and that's something that you don't want to happen again. So some regulation is absolutely necessary. Too much regulation also hurts markets.